and hand over to you.
All right. Thank you very much, Ole Christian, and welcome to this update with SKAGEN Focus. First of all, I hope you are all well in this very strange environment, strange times that we're living in. We are doing this presentation from our home base, but hopefully this will go okay anyway. We're going to take a look at primarily at the value opportunities we think the fund is facing in current global equity markets. We're also going to take a look at the portfolio composition and the operating environment which has sort of occurred in the aftermath or in the middle of this virus crisis that has rocked equity markets over the last few months. And we're going to take the questions afterwards, as Ole Christian indicated. So please, if you have any questions, just feel free to ask them. We can go to the next slide. First of all, just to remind you about the mission statement for the fund. What is SKAGEN Focus about? We have an unconstrained mandate, which means we can invest in any geography, any sector, any market cap size. This has resulted into a current weighting into small and mid-cap names, with mid-cap meaning up to $10 billion US dollars in market cap. Small cap would be 0 to 2 billion, up to 2 billion US. It's about 60% of the fund currently, and this is due to the fact that we have much easier to find value, our definition of value, in these smaller cap names than in the larger cap names currently, and that goes for primarily, or I would say very much for the US equity market, which still among the large caps are showing elevated valuations, especially in the Nasdaq-centric sort of space, with the super big tech companies still trading, software companies, etc., trading at very elevated valuations still. Our constraint is not the geography, sector, or cap size, it's valuation. As you well know, we are very price driven. We have a mandate to invest in undervalued securities, and our definition of undervalued is a 50% upside in 2 to 3 years on steady state or normalized earnings power. And thus this is a very conservative measure to value stocks. I would suggest to you there's probably 50,000 stocks listed out there, and probably 1,000 of these names are cheap enough for us to take a look at. Probably 500 of these names are liquid enough or big enough, even for our fund at approximately 1 billion NOK under asset management. I would also though highlight that during the correction we saw last month in global equity markets did briefly or temporarily at least increase our investable universe, and this has resulted into a number of new positions which we will go through with you in this presentation. We have a highly concentrated portfolio. It's 40 to 50% in the top 10 department. We're currently at 46%, and we apply a strict bottom-up and company-specific valuation metric. We have very little knowledge about the index composition. And we have a portfolio that materially differs from any other global equity fund out there, I would suggest to you, both in terms of geography and cap size and the investment cases in themselves. Also, our aim is to generate an absolute return over time with fundamental exposure factors underpinning our risk management process. So we did write an article. I don't know if you have seen this article. We just want to highlight that we have, it was actually before the virus crisis, we wrote a piece about the exceptional gap that has opened up between the expensive part of the equity market and the cheap side, which we're sort of operating within. This and the potential for this gap to close or sort of normalize over the next 2 to 3 years. This article is going through the reasons behind this development and also the potential catalysts for this thing reversing. And we would like to suggest to you that this crisis or this correction in equity markets has sort of pushed this process forward, and we may well be at that point where value again might be the sort of the leading part of the market in this upcoming recovery phase. We're going to take a look at how this worked out in the tech bubble and the global financial crisis on a slide coming up soon. This article is available on the website and also on the with your sales contact at SKAGEN. You can also contact us directly to get the full article if you're interested. The main message here, if you go to the first point here, if you click again. I'm sorry. We have a record low allocation towards U.S. assets at this point in time. It's only about 15% of our asset base now put in U.S. assets. But I also want to highlight that the new positions we have started to build are primarily U.S.-based recovery positions. And these are names we've been waiting for a very long time for these equities to get into our price range. We're going to give you a few examples of those names later in the presentation. We have in excess of 40% allocated to China, Korea, Japan. And there's a number of reasons for this. The first one being the equities are trading at a massive discount in these countries. Still, the gap towards US is getting increasingly elevated, especially in Korea and Japan. We have 25% of the fund in Japan in both small, mid-cap and larger caps, which are all trading, I would suggest to you, at a 50% discount to its US counterpart. And we have a few examples of these as we move along. We have in Korea, we have a Korean reinsurance company, which is a very cheap reinsurer in Korea. You also hold the Hyundai Motors, the pref shares, as well as KB Financial, one of the cheapest banks probably in Asia, still with a very solid balance sheet. The other thing being these countries are being ahead or much better equipped to sort of handle the current virus crisis, where we think US is currently in a very difficult situation, which equity markets has not yet really factored in, especially after this brief rally we've had since the lows in March. If you take next point. One of the reasons why US weighting has gone down is the fact that we had Kroger, our food retailer, hitting price targets in the last month, actually. Food retailing has obviously been one of the better places to be in. We initiated a highly contrarian position in Kroger, the traditional food retailer in US, last summer. It hit price target in the middle of the crisis, so it's one of our best, or the best performer this year in the fund. We also had San Martino, our ethanol producer in Brazil, hit price target early in the year. That was also a top 10 position in the fund. These were 4% each of the fund. But they have both left the fund for new positions, primarily initiated in the crisis. We've seen the weakness in equity markets, as I alluded to, has sort of increased our investable universe. It did temporarily increase it actually quite a lot in the US. In our investment library, we had a good selection of stocks to pick from. We ended up picking a few of these stocks, among them being Disney, the media company, trading in the US, that is a large cap. Finally trading in our price range. We will take a look at that. We also bought Citizen Financial, a US regional bank, as well as Pilgrim's Pride, the largest chicken producer in the US, among others. We could take next point. And I also want to highlight, and this is very important, that despite the recent run-up in the NAV from the lows, we have still a more or less a record cheap portfolio with in excess of 100% upside potential across this value contrarian based sort of portfolio, which is one of the higher numbers we've seen in the last few years. And importantly, these corrections in global equity markets, they often tend to lead in a change of leadership You know, the leadership in equity markets in 2010 has been driven by higher multiple names, names with perceived quality, perceived earnings growth, which has been seeing a huge multiple expansion due to lower interest rates, mainly due to lower interest rates. We think this situation right now is pointing to a reset and a new cycle starting, where value should be the leading indicator, the leading part of the market, which we've actually seen in the last few days only starting. This is our theory. We'll take a look at some of the more facts around this later. So what's been driving this latest rally from the lows? Well, the market has been really focused on the virus case growth, or the flattening of the curve, if you will. This has been the first phase of this getting out of this crisis for the markets. We see that the fear index, the VIX, the implied volatility of S&P 100, is quite close to tracking the country case growth, which is the countries going below 10% of active cases in this virus. Of course, this is the first part. Now the market has to take into account the earnings reports starting now, where it's going to be very weak reports, very weak guidance, of course, since we're going into recession. It's also going to be very weak macro data. So this is going to move in sort of tandem. There's going to be a volatile ride. At the end, there will be a recovery. There will be a real recovery. And that, I think, an interesting way of seeing this is scaling in gradually into value contrarian investment cases like ours in this environment. Next slide. And this is what the article alluded to, which we wrote, what's next for traditional value investing. You can see the blue line here is the value part of the market, which has been sadly been underperforming vastly. This is just over 2019 to 2020, whereas the size quality large cap part of the market has been extremely strong in terms of flows, and this is driven by a few parameters. Passive investing is one of these things. The other one being the multiple expansion from low rates. We now think this gap is totally getting to a totally absurd level, even historical context, and have the potential to reverse. And hopefully, you as investors can be a part of that in terms of investing into more into the blue line, or at least having a diversified sort of portfolio at this part in the cycle. Get the next slide. So I was alluding to the situation we've seen, and these charts are a little bit fuzzy. There's too many lines basically, but if you focus on the clear blue line and the clear red line, and the blue line being the cheapest names, global equity markets, and the red line being the quality part of the market, and that is basically the Nasdaq-centric, the high PE industrials, consumer staple stocks of the world, which we cannot afford to buy in our funds since we're price driven. And the line in the middle would actually indicate the lows in these recessionary or in these equity market corrections. And you can see in both these cases, you had a huge lead from value assets from the lows and and these corrections tend to lead at least 1 or 2 years. In the case of 2002, we know that the value lead extended all the way into 2007. So it was one of the better value markets historically that the one I've ever seen following the tech bubble. The global financial crisis was a little bit different. It was a shorter span of value outperformance. Then QE hit, and of course that was the start of the complete growth cycle that we've now probably, or for our sakes, hopefully seen the end of. And the Corona crisis has just begun. We don't know if we've seen the lows in these equity markets. We might have. In any case, the rotation into value have become visible in the last few weeks, and even the last few days has been very strong for us. And this is just a sort of an indication of what could happen if this rotation really gets into force here. So next slide, please. So let's just go through a number of these reasons why value should be coming back. Why should you stay invested? Why should you consider investing in our fund at this point in time? You have the extended period of value underperformance. It's more than 10 years. You have a NASDAQ-centric US base of stocks trading at elevated multiples. You have these spots elsewhere in the so these companies have become a huge part of the index, and just being bought because they're big, basically. And this is not rational in the long term. We think the disruptive impacts from these names are also sort of getting less relevant, which point to multiple contraction over time. The fiscal stimulus coming now, as well as the monetary stimulus, will be very beneficial for value assets if history is any guide. You'll see interest rates starting to rise. There's some of these experts out there even claiming that the stimulus is completely exaggerated, and this will turn into an inflationary environment where money policy is so loose that you will see these interest rates start to rise, which of course would be another headwind for the growth part of the market and really point to the value side of things. We'll see how that plays out. We've seen a number of industrial buyers, strategic buyers coming out since valuations have been so depressed even before the virus crisis. We've seen one of our names, for instance, West Fraser. It's a timber producer in Canada. Their main owner now bought stock for the first time in 5 years, and there might be a strategic event coming in here, which is very interesting. We also bought West Fraser. And yeah, we mentioned the inflationary environment. We can go to the next point. And you'll see that the capital flows, at some point, they will turn from the more growthy parts of the market into what we think is the cheap or the under-owned part of the market. And that when you have these momentum models turning the right to that part of the market, we think that's really going to be a violent rotation. And next point, yeah, this is what we've said all along. You will have if you just think about the growth rates in earnings for the cyclical commodity value names, for instance, the industrial names that we hold from the 2020 depressed levels into 2021, they're going to have huge growth rates if the recovery comes in. That's going to extend into 2022, most probably. And this will, in turn, make the growth rates of these other companies, like the software companies, pale in comparison. So this is another way of thinking of how can value outperform. We have our mandate, you know what we do, but these are the reasons which we also outline in the article as well, surrounding the potential for the fund here.
So as Jonas alluded to, we run a contrarian and price-driven philosophy where we identify investment opportunities that are undervalued by at least 50%. And we use a midterm horizon of 2 to 3 years, and we value companies based on their normalized earnings potential. And the phenomena that create these investment opportunities, they constantly vary across sectors and geographies. But when we look for value, there's a wide range of spectrum in which our philosophy can be applied and investment opportunities identified. And we have simplified it for you on the chart that you have in front of you, and separated into different buckets and given you examples from the current portfolio that we have. So the most common one is probably mean reversion, i.e. the tendency of fundamental variables to revert to mean over time, in absence of structural changes. And here, for example, we have Korean Re in the fund, which is a South Korean insurance company, and currently priced as if the bad historical underwriting will continue forever. And our thesis here is not built around that the company will be among the best in its industry, but essentially that it will become less bad. And our understanding is that management is moving in the right direction here. We also have Safran, which is a French premium producer of truck trailers, and which has a major aftermarket business that follows its own cycle, and while it's currently perceived to be a pure automotive supplier. Then we also have companies that can earn an above average economic return on assets due to a sustainable competitive advantage, which is not accurately priced. And this could, for instance, be due to intangible assets or through low-cost production. And here we have an example in the fund, a top 10 position, Roxgold, which is a Canadian gold miner. It owns and operates assets in West Africa, very high-grade assets. Or we also have our integrated energy company, OMV, which is a low-cost producer. Then, as we value companies looking at them from a midterm perspective, we can also find opportunities that arise from temporary market dislocations or companies that are trading well below their midterm normalized earnings potential. And examples here are, for example, ENCE, the Spanish pulp and energy producer, which we think is very attractively positioned to benefit from a normalization of the current global pulp market. Or we have West Fraser, as Jonas mentioned, which is a Canadian lumber producer exposed to the US housing cycle, which is currently trading well below normalized earnings potential. Then we have situations with where restructuring can help crystallize underlying value. We also have companies that have hidden assets on their balance sheet, which in different ways can be monetized over time. And to give an example here, we have Hornbach Holding in the portfolio, which is a family-run do-it-yourself group with highly valuable real estate ownership. And then we also have Japanese Taikoku Senai, which runs a very profitable disaster prevention business, but almost trades at a negative enterprise value, as the balance sheet is full of cash and investment securities in a real estate company. It's a very attractive position here, where you essentially get the whole core operations for free. And we currently see minority shareholders becoming more vocal, advocating for a more efficient capital allocation strategy. So very interesting.
Right, thank you. And you know, we're thinking a lot about the portfolio composition here. And I think you can call it a barbell portfolio approach currently, actually. If you take a look at the first sort of part, if you click forward, you can take one more there. So if you think about the portfolio as two different parts, basically, we have one part which is more of sort of geared versus a recovery sort of situation in global equity markets, which will come at some point. There's no doubt. We don't know if it's this autumn. We don't know if it's next year. But we think that the recovery will come in different phases, and we have different weightings in these recovery buckets, if you will, the way we think about it. And we have, for instance, the commodity value, which this was described, the commodity recovery positions within the fund. It's about 20% of the fund, or 19.7 to be exact. And this would be represented by copper miner Ivanhoe Mines, for instance, which is a 4% position in the fund. We have a 3% position in gold and copper miner Oz Minerals. Ivanhoe Mines is not producing currently. They're going to start producing in Q3. They have in their possession one of the largest copper reserves in the world, trading very cheaply to asset base. We also have Dow Inc. in US, a top 10 position, which is one of the largest chemical companies in the world, geared to the gas oil ratio, basically. That's their competitive edge. OMV is the Austrian energy company. West Fraser, the lumber producer we mentioned, and also ENCE. These names we would expect to be first out in a recovery phase, or this is the usual pattern, that you first see the commodity value recovery, and then you'll have most probably the industrial recovery, which might be a bit lagging. You'll see that we have about 18% of the fund in these names, which would be, for instance, Hitachi Construction Machinery in Japan. which is owned by Hitachi. We own both these. We think there's a tangible probability that Hitachi will take out Hitachi Construction Machinery or maybe sell it. Hitachi is in full force of restructuring its operations. We have Toyota Industries, the largest forklift producer in the world, also Japanese, of course, and Safran we mentioned, as well as Continental, the German auto and tire producer, which is really resilient from the tire side in this very difficult climate for auto and auto parts. We think Continental will do really well once the dust settles in that market. And lastly, we have the financial and consumer recovery values. We don't know the exact timing of all this, but then you will see that is also quite balanced. We have about 18% of the fund in these names, which would be, for instance, Bank of Kyoto in Japan. That's a special case. That's a capitalization. They have a capital base that is ridiculous compared to what they're actually doing and could distribute a large part of the market cap today to shareholders. We're waiting for that catalyst in that name. At the same time, we have Lincoln National, one of the largest U.S. pension providers in the U.S., which has been really hit in this crisis. We think is trading now at multiples extremely attractive for this asset, and we're gradually building our position here. Together with Citizens Financial, that's an RBS spin-off, a regional bank in the U.S., one of the more higher quality assets that now finally came into our price range. And we now see at least 50% upside in 2 to 3 years. And Disney is also gradually building that name. We're going to go through that in a few moments. And versus all this, we have assets which we call here as steady as she goes, or more steadily sailing ships, which sort of balance these recovery names. And we think a lot about the balance between these two segments. How should we position ourselves? We're fairly neutral, as you see currently. We'll do okay in both environments. But these more steady names like China Unicom, which is the largest position in the fund currently at 7%, followed by Telecom Italia, Taikoku Sanai, the disaster equipment provider we mentioned in Japan, Stock Spirits, that's a beverage producer in Czech, and you have Pilgrim's Pride, a new position that's fairly rapidly become a 2.5–3% position of the fund, as well as Rox Gold, which is pure gold miner, should have nothing to do with industrial metals and have done well as of late. So this is just to show you how we think about the portfolio composition right now, fairly balanced. So we can take next slide.
Right, so if we take a look at some of the major adjustments we have made to the fund during the last quarter, some of them have already touched upon. Pilgrim's Pride, so Disney, Citizen Financial and Befesa are some of the new positions that has entered the fund due to the equity market weakness we have seen. Many of them have been in our pipeline for quite some time. So Pilgrim's Pride has been in the portfolio before actually, and this asset now again trades at a 50% discount to fair value, and we believe that demand from food retailers will continue to be strong. Disney we will soon touch upon again, but this is a rare opportunity for the fund to really acquire this type of high quality asset at a discount. We mentioned Citizen Financial, the US regional bank, with a solid capital base, and then we have had the opportunity to start building a position in German service company Befesa, which is a German steel dust recycler with a very strong market position. We also increased some of our positions in the fund. We increased Telecom Italia and also increased China Unicom and Hitachi. China Unicom and Japanese conglomerate Hitachi are now the two names that represent the two largest positions in the fund. China Unicom following the recent weakness, we think should be very resilient in a downturn from here. It trades at very attractive 2x operating cash flow, and we think that the worries regarding 5G spendings are overdone, and that the company is very attractively positioned for the midterm. And also we think that the operational story in Hitachi is progressing very well, even though it's of course much more cyclical. We think it has a very attractive exposure to both Japan and China, which we think, as Jonas alluded to, could participate early in a recovery. It trades exceptionally cheap on midterm earnings and has a very strong balance sheet. We decided to close some of the positions in the fund. Hewlett Packard Enterprises was sold as we saw better opportunities elsewhere, especially in the new positions. We closed our position in Camphor Pulp and rotated some of that exposure into our other pulp investment situations. But we also closed 2 positions during the quarter. Kroger, the US food retailer, was closed at target price, but also San Martino was closed in the beginning of the year at target price. And we decided to scale down our position in Italian bank Unicredit, but also US telecom equipment provider Avaya. And this is mainly as we try to reduce our exposure to companies with above average leverage. So these are some of the major changes that has been done to the fund during the last quarter.
Yes, we mentioned Kroger actually hitting price target. This was a 4% position in the fund, so one of the bigger positions. And you'll see here on the chart how we, for once, timed this very good in terms of buying into the weakness in late last summer, when the asset was very discounted, and of course this is a victim of Amazon's success in terms of being food retailing online player. We thought the worries were vastly overstated. Same-store sales eventually turned. Warren Buffett took a major stake in Kroger, and of course food retailing has been one of the few places to hide in the crisis that we've seen. So a nice return there over the last 6 or 7 months, really. Can go to the next slide. And finally, we have the Magic Kingdom entering the portfolio in terms of Disney. We always had an eye out for Disney as being one of the names we wanted to hold. It never really traded in our price range of the last 2 to 3 years. Now, finally, it came down to $85–90, where we could see our 50% upside in 2 to 3 years. As you may well know, the parks are closed. There's no cinema nowhere on this planet currently. There's going to be a tough few quarters for Disney. They recently bought Fox News, 21st Century Fox, and took on some leverage. So that also has been a negative factor here. We think this is going to prove to be a temporarily setback for Disney. We think this is going to snap back to normalized earnings power, if not this year, in 2021. Its holder in one of the brand portfolio that Disney holds is really something extraordinary, and the brand was currently valued at an extremely high end. I think it was 43 billion or something US. Obviously they have Marvel, they have Star Wars franchise, they have the Disney franchise, Pixar, and assets that are invaluable in today's media landscape. Also, they are one of the few names that can compete with Netflix, and they just launched Disney Plus, and in just a matter of months they reached 50 million subscribers, which is it's incredible actually. Maybe the virus situation has sort of pushed that one in the right direction. We don't know, but we see a price target here sitting somewhere around $140 in 2 to 3 years, and it's currently quite small. We're gradually scaling into Disney here.
Yeah, and then another company that has been in our pipeline for quite some time, but never traded in our price range before, is German Befesa, which we also started to build a small position in and started to scale into. The German company Befesa collects and recycles steel dust and aluminium residuals. It operates in this niche market and provides a critical service where there's a very high barriers to entry. So the steel dust and aluminium recycling is highly regulated. It's a necessary service which leaves them quite uniquely positioned. They have a strong market share, 45 to 50% in Europe actually. They have a strong balance sheet and growth opportunities in Asia. And of course, the current price drop discounts a collapse in near-term demand, but we think that Befesa is exposed to a positive structural long-term growth opportunities, especially from environmental legislation and rising zinc content in steel dust. So very attractive opportunity that we started to scale into. And then for those of you who have followed us before, know that when we look at risk, we don't look at volatility or other statistical measures. We use fundamental risk exposure factors for portfolio construction and try to, through diversification, avoid unwanted systematic exposures to try to limit risk as we see it, which is the permanent loss of capital is the main risk. So we identified 3 factors, fundamental risk factors for each position on the fund. And what you see in front of you right now is the aggregated picture of our current top 30 risk exposure factors. And as you can observe, more than 25% of our exposure relates to asset values or capital allocation, and as Jonas alluded to before, 25% of the fund is exposed to Japan, where we find most of these investment situations. They have historically been very conservative, and it's crucial here to monitor capital allocation decisions so that value is not destroyed. And this is why we have monitored these risks or assign these risk factors to these positions. It's also interesting to note that this has become a luxury problem in Japan. These companies has historically been very conservative and accused for having too much cash, but as most of the world now experience a complete drop in demand in the short term, it's a big luxury problem for these companies to have excessive balance sheet full of cash, which gives them a lot of opportunities to maneuver and do interesting capital allocation decisions. Another observation which we think is very important to make is that the risk factor assigned to leverage, so companies in the fund that has above average leverage, is at all-time low, at 5%. And this is something we have consistently been working with over the last year and been taking down. So decreased exposure towards leverage.
Well, looking at 2020 winners and losers, you'll see Kroger mentioned there as the best performer in the year. Taikokos and I have been holding up very well, should have done so as well, considering what they're operating with, disaster equipment provider, with a huge non-core asset in Hulik, been holding up quite well as well. San Martino we mentioned, also price target out in January. Pilgrim's Pride been very good this year, as well as Rocks Gold snapping back here in the last week or so. They also had an update on their new Segula asset, which is looking very promising, going from being a one asset to a 2 asset company with a payback period there of less than 1.5 years. And amazing numbers coming out from Rocks Gold. That's 5% of the fund currently. Whereas our loser has been Lincoln National, and that's been a smaller position that we've sort of scaled into here. We were a bit early, and we're currently sort of still accumulating here. OMV, the Austrian energy company, being weak following the energy price collapse, of course. We think the balance sheet is really good. This is a solid operator, so we don't see any financial risks there. Dow, we've been increasing Dow one as well at really interesting levels. The yield here is about 10%, and it's safe even at current crude oil levels, Dow being pricing most of the chemicals of the crude curve. And we have also seen a weaker development in Ivanhoe Mines and West Fraser, which we think in West Fraser there you had the main owner now increasing his stake for the first time in many years, and we think that's a very interesting indication of value in that space. So we have 35 positions, as we should, 46% in the top 10, and you see the top 10 here. Fairly balanced, we think, between these different themes we've been describing for you. Of course, what pops out here is the upside potential. Over 100% weighted upside to our price targets, which are very conservatively set as well. Trading just at less than 8 times earnings and less 1 time price book, with still a decent sort of normalized return on equity potential for next year. Obviously, many of these names will have cyclically depressed earnings this year, while next year would be really interesting, and this really points to a future potential here. So just to sum up, I think our time is ending here. We have initiated several new investment cases. We mentioned Disney, Citizens Financial, Pilgrim's Pride, Befesa, into weakness. The portfolio is quite balanced currently, but we could get more aggressive on these recovery themes that we've described for you, and we're gradually approaching a recovery. That's going to be a timing issue here. Record cheap levels in excess of 100% upside across the portfolio. And importantly, and this is probably one of the main points here, that we think that this environment we're in could provide the turning point that we have sort of looked for in terms of growth versus value, and really been, if not for anything else, the massive growth rates that these names could post in 2021, 2022 over depressed levels, and should really lead a recovery here in global equity markets. The timing is, of course, very uncertain at this point in time. This is the sort of what we had for you today, and we're happy to take any questions.